Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 26th of January 2015. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. If you are viewing or listening to this video anywhere other than on our Hurst Trading Room podcast channel, then make sure that you subscribe to the podcast channel on iTunes or on YouTube. In that way you will be alerted to new videos as soon as I record them. And please make sure that you get involved in the conversation about Hurst cycles. Click on the Spot IM circle, which you'll find at the foot of any one of our website pages. Let's take a look at the markets. And in last week's video I spoke about the divergence between the European markets and the US markets, and I explained my reasons for not expecting the US markets to be as bullish as the European markets. Here is a chart of the S&P 500. As you can see, price did cross up above the 20-day FLD last week, and I discussed that and mentioned why I didn't see that as a very good long trading opportunity. Of course, the markets might still go up further and it might turn out to have been a great long trading opportunity, but at the moment I'm not sorry to have missed that trading opportunity because price has not yet reached the target. You can see the target which is generated from that low point, the 40-day cycle trough in the middle of the week of the 12th of January. The move from that low point up to the level at which the FLD was crossed, which happened last week, is over there, and of course our target is an equal distance to the upside, and that's somewhere over there. We don't have to work out the exact number for now, but you can see that that target has not yet been reached. It might still be reached, of course, but it hasn't yet been reached, and the move is not looking very impressive. It is looking impressive, of course, in the European markets, but we'll take a look at those markets in a minute. The next move, and the move that I am more interested in trading in the US markets, is the move down to the 20-week cycle. So here you can see at the foot of the chart the nest of lows for the 20-week cycle, which is over here, and that trough is expected from about the middle of February until perhaps the beginning of March. And of course we expect price to form a peak. It might have done so already, or it might do so sometime over the next week or two, and then it will head down into that 20-week cycle trough. Now I am expecting that to be a better trading opportunity. It will be a short trading opportunity, and I discussed many of the reasons last week. But let me just quickly run through a little bit of a reminder in terms of why I'm expecting a better short trading opportunity than the current long trading opportunity. And that has to do with, of course, the shapes of the cycles. And here is the 80-day cycle bouncing out of the trough in the middle of October, which, as I discussed last week, I believe is probably of 40 magnitude in the US markets, 18-month magnitude in the European markets, which is why there is a difference. But there is the 80-day cycle that elapsed from the middle of October until the middle of December. A very good bullish 80-day cycle, which of course we expected because the 20-week cycle was heading up and the 40-week cycle was heading up. Then we started seeing some bearish signs, which I discussed last week, and in particular you can see that this 40-day cycle, which elapsed from the middle of December until about the middle of January, was not very bullish at all. And if I clear that, you can see why I say it isn't a particularly bullish cycle. As you know, there are two measures that I use to determine the bullishness or bearishness of a cycle shape. The first one is the relative position of the troughs. And so the closing trough for this 40-day cycle was at that level over there. We don't have to get the exact figure. And it was, as you can see, higher than the starting trough, or the level at which the cycle started. The fact that the closing trough was higher than the starting trough means that was a slightly bullish cycle, very slightly. because there was a very small difference there. The other thing that I use to determine the bullishness of a cycle or bearishness of a cycle is the point at which the peak occurs in terms of time. So let's just measure that. I can count the bars here. You can see that peak occurred 13 days into the cycle. The full cycle was a 31-day cycle, and so the peak occurred before the midpoint of the cycle. The midpoint was, of course, 15.5 days. 13 days is before the midpoint of the cycle, and therefore that is a slightly bearish indication. An early peak is a bearish cycle shape, and so we have a mixed cycle shape here. We have a slightly bullish cycle because of the fact that the closing trough was higher than the starting trough, but we have a slightly bearish cycle because the peak occurred earlier than the midpoint of the cycle. So a very mixed cycle shape for that 40-day cycle. And as I discussed last week, that is a fairly clear indication that the US markets are beginning to turn bearish. But of course they aren't bearish yet. It doesn't mean we must sell everything and just immediately jump in on the short side. But it is an indication that the US markets are shifting towards more of a bearish mode, or certainly that the bull mode that we've been enjoying for several years is probably drawing to an end, because we are beginning to see some bearish signs. For those reasons, I wasn't particularly interested in the long trading opportunity, the E category trading opportunity that presented itself last week with the price crossing up above the FLD in the US markets, but I am interested in the next trading opportunity, which is a short F category trading opportunity, and a good entry level, of course, is the point at which price crosses that FLD. Let's quickly take a look at that chart in Hurst signals. There's the S&P 500 in Hurst signals, and as you can see, the Hurst signal system is expecting the next trading opportunity to be an F category trading opportunity, and it's indicating the level of the FLD as an entry level for that short trade. So I think that is going to be our next trading opportunity in the US markets. Now there's a subtlety here in terms of the analysis that I'd like to point out, particularly if you are a Sentient Trader user. You'll notice that I've been speaking about this trough in the middle of January as the 40-day cycle trough, and down below here you will see the circle and whiskers for the 40-day cycle trough. And you might be asking why Sentient Trader, the software that's performing the analysis, hasn't positioned a diamond to mark that trough, because it looks fairly obvious looking at it that is the trough of the 40-day cycle. This is something that bothers some users when they start working with Sentient Trader. They can see a trough that really looks obviously a 40-day cycle trough, but the software isn't marking it yet with a diamond. It's leaving that circle and whiskers over there. There are various reasons why Sentient Trader doesn't do that. One of the primary reasons is because there is not yet enough evidence in the price movement to absolutely confirm that as a trough of the 40-day cycle. I won't bore you with the details of that, but there isn't actually enough evidence for the software to position that diamond. But the really important thing is that it doesn't really matter whether the software has positioned the diamond or whether it's simply plotting a nest of lows. People working with the software often get very hung up on the fact that there's still a nest of lows. There isn't actually a diamond there. That means the trough hasn't actually occurred. Not at all. A nest of lows is as good in many ways as a diamond, because it tells us that we were expecting the trough to happen at that time, and in fact you can see that the trough was expected on exactly that day according to that circle and whiskers. It's not a problem that diamond hasn't been plotted there. We can work on the assumption that trough, because it was expected there, and there is the nest of lows, that trough most probably has occurred, particularly when we're trading with the FLD, because the FLD will hardly move at all when that diamond is actually positioned. It might shift slightly, often by less than a bar. So that's a little subtlety that I thought that I would mention. As a matter of interest, if we take a look at some other analyses, you will see that that 40-day cycle trough has been positioned on that day. Let's take a look at the Dow, for instance. Now here's an analysis for the Dow. You can see that I haven't actually adjusted the magnitude of this trough back in the middle of October. It's still showing me an 18-month cycle trough. That's because it doesn't bother me too much. I could fiddle around and I could get it absolutely right and adjust that and make it a 40-week cycle trough, because that's what I believe it was, as discussed at some length last week. But the more important thing, in my opinion, is the breakdown of the most recent cycle activity. And here you can see that trough in the middle of January has been phased and has been marked as a 40-day cycle trough. And so the analysis on this chart in the Dow is pretty much exactly the same as the analysis in the S&P 500. Some people perhaps consider my approach slightly laissez-faire, in that I'm not too worried about that 18-month marker over there in the Dow. I'm not too bothered about it, but analysis, I believe, is as much an art as it is a science, and sometimes you need to have a little bit of flexibility, in my opinion. But let's take a look at some of the other markets. Now, let's take a look at the European markets, because, as I mentioned last week, the European markets, I believe, did experience an 18-month cycle trough back here in the middle of October. And there was a divergence that started developing between the European markets and the US markets, which is what made me question the magnitude of that trough in October in the US markets. And as you can see, the European markets have been very bullish, and they've continued rising up. And the discussion that I presented last week really implied that the European markets were going to be more bullish than the US markets. And I think that the European markets are going to start moving towards more of a bearish mode, but we're still very much in a bullish mode in the European markets. Let's take a look at that same 40-day cycle trough in the DAX. And of course we could debate whether the 40-day cycle trough in the DAX occurred here in the first week of January, or over here there was a bit of a drop down in the second week of January. It's a debate that we could have, and I'm not particularly convinced either way. I'm not particularly worried about where I'm positioning that trough. I think it's more likely the trough occurred in the second week of January, in the middle of January, because that's where it occurred in other markets. And if we take a look at some other European markets, for instance, let's take a look at the CAC 40, which is the French market. Here you can see the 40-day cycle trough has been phased by Sentient Trader as occurring in the second week of January, right in the middle of January, same as the US markets. And so I think it is likely that 40-day cycle trough did occur there. Let's take a look at the FTSE just as a matter of interest. Here you can see the FTSE, and the FTSE quite clearly did experience its 40-day cycle trough in the middle of January. But let's speak just quickly about why it is that the European markets are considered to be more bullish than the US markets, in my opinion. And so let's zoom out on this chart of the DAX. There we go. Now let's display semicircles so that I can explain why the European markets are expected to be so much more bullish. Of course, here's our big trough in March of 2009, which was, in my opinion, probably a trough of at least 9-year magnitude. Here is our first 4.5-year cycle, which I've spoken about in all the videos I've recorded in the last few months. That's the 54-month cycle trough. And now, of course, the market is in the second 54-month cycle and is expected to form a big 9-year cycle trough over here, sometime in late 2017, perhaps early 2018. And so Each 54-month cycle, of course, consists of 3 18-month cycles. There's 1, 2, 3 in the first 54-month cycle. Here's 1 and here's 2, and there will be 3 in the second 54-month cycle. Now, according to my analysis of the European markets, the 18-month cycle formed in the middle of October. And so, therefore, we are still very early in the second 18-month cycle. And that is why the European markets are more bullish. Can you see that? Now, before you get too confused, the easiest way, in my opinion, of working out what the general mood of the market is to take a look at those semicircles. And here you can see the semicircles, the 54-month cycle at present. If you consider the semicircle as a vector, the 54-month cycle is still heading up. Can you see that? And the 18-month cycle at the moment is also still heading up. So we've got 2 cycles at least that are still heading up. The 9-year cycle is almost certainly heading down. But we still have 2 cycles that are still heading up, and therefore there is still quite a lot of bullishness there. Let's take a look, on the other hand, at the US markets. And let's display our semicircles here. Now, you can see that according to this analysis, the 18-month cycle trough is positioned earlier in February of 2014. I discussed this last week, so take a look at that video if you haven't seen it. And the trough in October of 2014, in my opinion, was a trough of 40-week magnitude. So what does that mean? Well, in terms of the 18-month cycles, in the current 54-month cycle, that means that we are later in the current 18-month cycle. In fact, quite a lot later. And if we take a look at the directions of those semicircles and use them as vectors to determine the current direction of the various cycles, you'll see that the current direction of the 54-month cycle is down as opposed to up as it was still in the European markets. What about the current direction of the 18-month cycle? It is also down, and in fact it's quite strongly down. If you look at the angle of that arrow, the angle of the semicircle, it's also down. So whereas the European markets look as if though they still have an upwardly moving 18-month cycle and an upwardly moving 54-month cycle, the US markets, in my opinion, have downwardly moving 18-month and 54-month cycles, which is why I believe the US markets at the moment are currently more bearish, or at least they have turned bearish, or they are in the process of turning bearish sooner than the European markets. One final point about the European markets before we move away from this discussion, and that is that there's been a lot of fundamental interaction in the European markets, and I think that that is very likely why there's a little bit of confusion around the position of the 40-day cycle over here. What is fundamental interaction? It is the result of news events or things that happen that influence the markets. Now, recently there have been a few things that have happened in European markets. Well, things that have happened that have affected markets around the world. The first was, of course, the lifting of the Swiss franc peg against the euro. That affected markets around the world. It particularly, obviously, affected the Swiss franc. It affected the euro as well. It then, of course, also affected European stock markets, and to some extent it also affected the US stock markets, but to a much lesser extent. That occurred on, I believe it was it Wednesday or Thursday, about 2 weeks ago, so round about the time that the 40-day cycle trough was probably forming, the Swiss National Bank lifted its peg against the euro, and I think it was this bar over here, this Thursday bar, a very volatile bar, a lot of movement because that was happening. That's what we call fundamental interaction. news events. You probably know, in my opinion, and according to most Hurst cycle analysts, news events don't move the market. They might cause temporary volatility. They might provide the trigger for a turn in the markets. But of course, it is the cycles that we look at, which in our opinion, or in my opinion, perhaps I shouldn't speak for other people, in my opinion, it is the cycles that provide us with the underlying roadmap, if you like. So what's going to happen to these markets? Well, let's just plot that FLD, because the 20-day FLD is very useful. As you can see in the European markets and in the US markets, we're looking at a short F category trade next as price comes down to form the 20-week cycle trough. Now, the 20-week cycle trough is expected from about the middle of February until early March, so we are looking at a move down into that trough. The move down, I believe, is going to be more impressive in the US markets than it will be in the European markets, because of course the European markets, as I've just spent some time explaining, are in more of a bullish mode. They still have 18-month and potentially 54-month cycles pushing upwards, whereas the US markets are pushing downwards. And so we're enjoying a very good bull run in the European markets at the moment. The move down into the 20-week cycle trough will be a move worth trading, I believe, in the European markets. So I will be going short the European markets for that move down into the 20-week cycle trough towards the end of February. And certainly in the US markets, I believe, let's take a look at the S&P 500 and let's zoom in there again. The move down into the 20-week cycle trough is going to be a move worth trading. Because of course the US markets have been particularly bearish recently, and or at least not as bullish as the European markets, and so there we go, we are looking at a move down into the 20-week cycle trough. Now I would like in today's video also quickly to discuss what's happening in the euro, because the euro is reaching a very interesting point. I believe that it is approaching a point at which it's going to turn. It's been plunging downwards, as you can see from this chart. Here is an analysis of the euro, and I would like to point out a few things and make a very important point about using Hurst cycles analysis when you're analyzing a market, in terms of what do you do when those cycles become a little bit difficult to distinguish. And the euro is a really good example that I can use to explain how one should approach a market when the cycles become a little bit difficult to distinguish. First of all, the big picture. Here we are back in June of 2010, a very prominent trough over there, which according to this analysis has been phased as a 54-month cycle trough. 54-month cycles is of course 4.5 years, and here you can see the orange semicircle showing the path of the 54-month cycle, and you can see that the next 54-month cycle trough is expected fairly soon. And in fact we can count some bars and work out exactly when it is expected. And now the 54-month cycle, here we go, let me count the bars to 54 months, is about over there, 54 months. So that was in, where was that? Early December, the first week of December 2014. So that would have been exactly 54 months in early December 2014. The recent average length of the 54-month cycle, according to this analysis, you can see at the bottom right-hand corner of the chart, is 56.1 months. I hope you can read that figure. Anyway, even if you can't, it's 56.1 months, and 56.1 months is exactly where the point of that semicircle is. And if I read the date, that is the 9th of February 2015. So that means that the 54-month cycle has been expected to form a trough sometime between early December of last year and early February of this year. So in other words, we're right in that time zone where that 54-month cycle trough is expected to occur. Now let's have a look at the breakdown of the shorter cycles, and this is where things get a little bit interesting, because of course we expect, as I've already discussed, 3 18-month cycles to form within any 54-month cycle. But can you see how on this chart of the euro it looks as if though we've seen 1 cycle, 2 cycles, as opposed to 3 cycles? So there's a little bit of a dilemma here. What has happened to those 18-month cycles? Where are they? Well, there are 2 or 3 possibilities, and I'm going to quickly run through them, and then I'm going to explain to you why, in my opinion, in terms of making trading decisions, it doesn't matter too much that there is analysis uncertainty. It's a very important point of analyzing markets using Hurst cyclic principles. It's why I love trading markets using Hurst, is because even when there is analysis uncertainty and you're not absolutely sure where some of those cycles are, you can nevertheless make sensible trading decisions. So this is the one possibility, in my opinion, and as you can see, Sentient Trader also thinks so. That is that the first 18-month cycle was over here. There's the trough, and it completed in July of 2012. So that was a very long 18-month cycle. I think it was about 24 months or 25 months. Then the next 18-month cycle was a fairly short cycle over here, which ended in September of 2013. And then we have the third 18-month cycle. So in fact I should have drawn that first cycle over there. So that's 1, 2, 3. That's the one possibility. It's not a perfect analysis. There are things we could debate. I'm not going to waste time with that now, but obviously this placement of the 18-month cycle trough is a little bit questionable. We could argue it. Let's not bother for now, because I'm going to come back in a moment and explain why we don't need to worry too much about it. Let's take a look at another possibility. This is also a distinct possibility, that the first 18-month cycle played out and ended with this fairly prominent trough in January of 2012. So that's cycle number 1. Our second 18-month cycle has an interesting shape, and I'm actually going to draw it as an M shape, because of course, you know, I believe cycles form M shapes in markets. And so there is our second 18-month cycle, which then formed a trough in July of 2013. And since then, we have seen the third 18-month cycle play out. And of course, that cycle is due to form a trough very soon. Now, this second cycle, the middle cycle, is an interesting shape, as I mentioned. It's what I call an inverted cycle shape. Now, that's something I came up with. It's not really something that Hurst ever spoke about. And here you can see why it's an inverted cycle shape. Most M's don't have the central trough of the M, the center part of the M. They don't have that down below the starting and ending trough. So an inverted cycle shape, I've just drawn over there, has the central trough below both the starting and the ending trough. And as you can see, that cycle number 2, that second 18-month cycle, is an example of an inverted cycle shape. Now, it's not impossible. Most analyses have inverted cycle shapes somewhere in them. But in my opinion, an analysis that has an inverted cycle shape is usually not as good an analysis. But this might be an example where we had an inverted 18-month cycle shape. Now, why do inverted shapes happen? In my opinion, they occur often because of fundamental interaction that I spoke about a moment ago. Fundamental interaction usually only affects markets for a brief period of time, but sometimes, particularly when there's a lot of turmoil going on, it can distort cycle shapes over a period of several months. And of course, what was happening in the euro during this time? Well, we've had what people refer to as the Eurozone crisis playing out for some time. And we could look at the dates and discuss the details, but the point is that there is potentially motivation for there to have been an inverted cycle shape forming during this period, because the Eurozone crisis has been very powerful news, which has been obviously influencing the value of the euro against the US dollar. And so it's not impossible that this inverted cycle shape formed. Let's take a look at a third possibility, which is this possibility over here. And that shows us that we had potentially a first 18-month cycle over there forming its trough in July of 2012. You can see that matches the first analysis that I showed you, and the second 18-month cycle has a slightly later trough over here in November of 2013. That's the second cycle, and then the third cycle is still playing out over here. And so this analysis is very similar to the first one, but there is a subtle difference, and that subtle difference is that the 18-month cycle trough that we're currently expecting now is only going to occur quite a lot later, as you can see from this nest of lows at the foot of the chart. Now, all three of these analyses are telling us that we're expecting, of course, a 54-month cycle trough to form sometime soon. They're also, all of them, telling us that we're expecting an 18-month cycle trough to form sometime soon. This third analysis that we're still seeing on the screen at the moment is the analysis that expects that 18-month cycle trough to occur the latest out of all three of them. So you might ask yourself, but with this uncertainty at a scale of 18 months, we're talking about a position of 18-month cycle troughs, with an 18-month cycle uncertainty, if you like, how is it possible to make sensible trading decisions? Well, now this is what I do. I take a look at the alternates, all the possibilities, and these three are the primary possibilities in my opinion. And I take a look and I see, is there anything that these analyses have in common? Is there anything that we can latch onto? And you can go back and look at them all in your own time, but let me show you quickly what is common between all of these analyses. Okay, here's an 18-month cycle trough. Now that trough, as I've already explained, is not common. Here's a 40-week cycle trough. That 40-week cycle trough, you will also see, is not common between all the analyses. But here's a 20-week cycle trough in the beginning of October or the end of September 2014. That's a 20-week cycle trough. Now that is common between all three of the analyses. Let me show you. That's the third analysis that we looked at. Let's go back to the second analysis and work our way backwards in that manner. Here is a 20-week cycle trough. You can see it's been pinned, which means I've influenced the analysis, but it makes the most sense, and I won't bore you with the details, it makes the most sense that that trough at the end of September or early October 2014 is a 20-week cycle trough. Let's go and have a look at the first possibility. Here it is, and you can see that here as well the 20-week cycle trough is phased as having occurred at the end of September and or the beginning of October. Now you will find when you have analysis uncertainty, particularly in the longer cycles, when you take a look at all the possibilities, all the possible analyses that might be playing out, you will find that at some cycle level there will be a level of agreement between the analyses. In this case, we have an agreement at the 20-week cycle level. So now let me show you how we can make trading decisions on the basis of that. Let me zoom in on the chart and let me choose the second analysis that I showed you because it has the most regular cycles, and in many ways I think it is possibly the better analysis, but let's not get into too much of a debate about that now. Let me zoom in so that we can see the 20-week cycle trough that these analyses have in common and see what has happened since then. And I'm not going to keep switching between the analyses because the analysis since that 20-week cycle trough is in fact exactly the same in all of these possible analyses. So here is the 20-week cycle trough. You can see it occurred in the last week of September. There it is, last week of September 2014, a 20-week cycle trough. Now, what has happened since then? Well, the market has been coming down really hard, as you can see, which makes it very difficult to perform a very good cycle analysis. So again, we have an added layer of uncertainty, but don't let that put you off, because we can still trade this market. Now you can see this big nest of lows over here. It's a bit staggered, and it's showing us the 54-month cycle trough, which is expected, according to this particular analysis, in the middle of March, and some of the other analyses it was expected as early as December, or around about the middle of February. So now we're approaching the end of January. The important point is that 54-month cycle trough is expected round about now. Here's an 18-month cycle trough, circle and whiskers. Also expected round about now. We don't have to sweat the details. We know we're expecting an 18-month cycle trough. What has happened since the 20-week cycle trough at the end of September 2014? Well, in fact, we've seen a fairly good, but very bearish, of course, 80-day cycle play out into the trough on the 8th of December 2014. Can you see that very good M-shaped 80-day cycle that played out as the market came down into the trough on the 8th of December? What has happened since then? Well, the market bounced up a little bit, and then it started its strong move down, accelerating to the downside. Now, what happens when an instrument or a market approaches a really long cycle trough? You will find that the market will accelerate to the downside, and that is exactly what's been happening in the euro to US dollar, which shows us that this market is definitely approaching that really long cycle trough, or it's an indication that it is. It doesn't mean that cycle trough is occurring today, or is going to occur within a week or next week. But the important thing is that clearly the market is heading down into that cycle trough. Now, we have a good position for the 20-week cycle trough. That looks good. I give that a tick mark, and it is agreed upon between all of our possible alternates. So, therefore, with confidence, I can state that the trough at the end of September, or in fact, I think it was in the first few days of October 2014, that trough was a trough of 20-week magnitude. Further, I can say that the trough on the 8th of December also looks good and clear to me. Let's just measure the length of that cycle that played out. From the trough in the beginning of October to the trough on the 8th of December, that was a 66-day cycle. What's the average length of an 80-day cycle? It is in fact 68 days. So that cycle was only 2 days short. So that clearly, in my opinion, is an 80-day cycle that played out in the markets. That means that I can move my level of confidence forward to the 8th of December, and I can say with a good deal of confidence that the trough on the 8th of December was a trough of the 80-day cycle. How long will the next 80-day cycle be? Well, we don't know, but we expect it to be somewhere between about 68 days, which is the nominal length of the 80-day cycle, up to as long as 77 days perhaps, because that's the recent average length of that cycle. It could be even longer. It could go all the way into March, could take us to a 90-day cycle, or it could be shorter. It's very important to remember the principle of variation tells us that cycle wavelengths are constantly varying. So the important thing is that we need to stand by. Now, it looks as if the market might have formed a small trough this morning, early on the 26th of January 2015. Of course, Greece voted yesterday, and that no doubt had an impact on the movement of the euro. It sent it tumbling in very, very early hours of this morning, but it looks as if though the euro's pulled itself back up a little bit. Possibly it's forming a trough, and that trough would be at a distance of 49 days from the 8th of December. Do we need to worry about the magnitude of that trough? No, because it hasn't formed the trough yet. So it doesn't really matter. Is it the 40-day cycle trough? Is it possibly a very early 80-day cycle trough? Well, we don't know. But we are able to make sensible trading decisions by using our Hurst cycle tools. So let me plot the 20-day FLD, there we go, and also the 20-day VTL. Now, these tools provide us with very useful information. When the 20-day FLD is crossed, then of course we know that the 20-day cycle has formed a trough in the market. Well, the trough that's forming in the market at the moment is possibly a 40-day cycle trough, maybe a very early 80-day cycle trough, maybe it's the 54-month cycle trough that we're expecting. So using the 20-day FLD to determine that is probably premature, but it would certainly give us a very early indication. What about this 20-day VTL? Well, if price crossed up above the 20-day VTL, it would tell us that a trough of at least 40-day magnitude had formed. Maybe even a longer magnitude cycle trough has formed at that point. And so how do we make sensible trading decisions? Well, there are two stages to this. The first thing that you need to do is advance your level of confidence in terms of the recent cycle activity as far as you possibly can. And in my opinion, as I've already pointed out, I can advance my confidence in the analysis all the way up to the 8th of December, which I would say with some confidence is a trough of 80-day magnitude. 49 days have elapsed since that point, and so I am standing by for the formation of a trough. However, the second part of making sensible trading decisions is you look at the magnitude of this trough that we're expecting. Now, if the market's bouncing out of a 40-day cycle trough, which is possible, and it's still got to go further down into the 54-month cycle trough that we're expecting, then I'm not really interested in going long yet. And so the second part of making sensible trading decisions is to wait until you have enough evidence that the trough that you are trading has certainly formed in the market. Going long at the moment in the euro would be a little bit like stepping in front of a fast-moving train and expecting it to stop. The euro is heading down into a 54-month cycle trough. It is accelerating to the downside. We expect to see it turn around soon, but I would like to see a little bit of evidence that the market has turned before I actually get into the long trade. And so what that means for me is that when a market is approaching a very, very long cycle trough, I don't try to catch the exact moment of the turn. I think that's foolish because you can get stopped into a trade much too early. And so I will wait until I see evidence that the market has turned. And the most useful evidence that you can find in a market is the formation of a bullish cycle shape. Let's go back a little bit. Let's backtrack to October. In October, or the end of September, I was expecting, of course, the 54-month cycle trough to form because I knew it was coming probably sometime in November, December, or early 2015. The market formed a little bit of a trough, of course, the 20-week cycle trough we now know with the benefit of hindsight. It formed that trough and it bounced upwards. Did I jump into a long trade at that point? No, I didn't. I watched to see what cycle shape formed. And here you can see the cycle shape of the 40-day cycle. Is that a bullish or a bearish cycle? That's a bearish 40-day cycle. I won't bore you with the details. I'm sure you can work that out for yourself now. That was a bearish 40-day cycle. Well, a bearish 40-day cycle is not what you expect following the formation of a 54-month cycle trough. So therefore, I knew immediately it was premature. What about this cycle that formed over here? The next 40-day cycle, was that bullish or bearish? It was a bearish cycle shape. Okay, so I knew it's still too early to get into the market. In my opinion, you must wait for a bullish cycle shape to form before you get into long trades following the formation of a very long cycle trough. That's the important thing. If this was a 20-week cycle trough or a 40-week cycle trough or even perhaps an 18-month cycle trough that was forming now, then yes, I would try to catch the turn on the 20-day FLD. But seeing as it is probably a cycle of at least 54-month magnitude, I'm not going to try to catch the turn on the basis of the 20-day FLD. I will wait for the formation of at least a 20-day bullish cycle. So I'll be looking for a good bullish 20-day cycle, and I will probably wait and hope to see the formation of a bullish 40-day cycle before I get into the long trade. Remember, the cycles will keep going. They keep beating you. You will keep getting more trading opportunities. I believe it's foolish to try to jump in and catch the first long trade out of a 54-month cycle trough. I think it can be a little bit dangerous. Thank you very much for joining me in the Hurst Trading Room this week. I am going to be releasing Hurst Trading Room videos a little less frequently. I've received some very useful feedback, thank you, and many viewers and subscribers to the Hurst Trading Room podcasts have suggested that I make the videos a little bit more in-depth, which I have done today, and release the videos with a little less frequency. And so I will be releasing a new Hurst Trading Room podcast video in about 2 or 3 weeks' time, depending, of course, on what the markets do. So I look forward to seeing you then, and I wish you in the meantime profitable trading.